Hello, this is WallStreetWindow.com. I'm speaking with David Skarica, runs the website AddictedToProfits.net. How you doing today, Dave?
Good, Mike. How you doing?
Oh, good. Well, we're doing this video right after the close on the Wednesday that the Fed did its interest rate hike. They raised the rate by a quarter point and then made projections they could do it by 3 points next year, possibly. Definitely 2. And the Dow fell on that news. It rallied into the meeting, but then fell on the news, and gold got hit. Gold fell $16. It's trading as we're speaking around 1140 in the gold stocks. They also fell after being up in the morning. So what's your thoughts of what's going on?
Well, first of all, I think you have to look at something from a big policy standpoint. Me and you have talked about this in a couple interviews recently, is that what's interesting about what's going on in interest rates is, like a lot of the policymakers that are around Trump, they actually don't believe in these negative rates and zero rates, right? NERP or ZERP or whatever you want to call them. They actually believe that it takes money away from savers, that it actually reduces investment because it makes money so cheap that all companies are doing is buying back stock and borrowing money and et cetera. So, and it's, that's what they actually believe, a lot of his policymakers. So what's interesting about the rates going higher is, maybe the last administration, a couple administrations wouldn't have liked this, but I think he's not going to be so much, against it. Obviously, he doesn't want rates going too high, but I think his administration's a little different on kind of this zero rate policy. And secondly, if you just look at it, that Yellen's probably gone next year. Obviously, most of the people at the Fed are probably no fans of Trump. And you got the stock market with this huge rally in the last couple months, nearly 20,000 on the Dow. I figure they're going to raise 3 or 4 times, or want to raise 3 or 4 times next year. Now, who knows if the market will start to fall to prevent that from occurring. But I just figured that, this is what they want to do. They actually want to raise a bunch so they can actually have some leeway to cut, right? So them saying they're going to raise 3 times next year, most people only thought 2, and I think they'll be open to 3 or 4 rate hikes next year. Does not really surprise me whatsoever. I don't know about yourself, but I even bought to hedge. I bought a gold bear fund, which was up about 11-12% today, because I figured that this could very well be the case. And some of these hedge positions that I have, I've been kind of averaging in, because the market is now overbought so badly. The RSI and the Dow Jones is 87, which is unbelievable. And it's so overvalued now. And we see so much exuberance in the market. I am in the first or second quarter beginning to worry that we're going to see a big time decline, because nothing's happened yet. Like, I do think that there are some key policy shifts coming under Trump, but really these things are going to take time. And I definitely think the market has got ahead of itself in terms of a lot of these things actually being implemented, right?
Yeah, well, we definitely had a tremendous rally since Trump's election, and this is really the first day in which the market has dropped. Probably more than 100 points on the Dow. At least it feels that way. I'm looking at the chart. It looks like this is the first day that's happened. And I don't think that means this moves myself. I don't think it means the move's over, but we could see weakness for another couple days. And I mean, I just don't really think we're going to see a huge decline until sometime next year.
The difference between this year and last year is this year, this big rally has made the markets up quite significantly on the year. Let's say, I think you began the year around 2040 on the S&P. I think last year the market was down 1% or 2%. So you're at 2040 in the S&P. Right now you're, say at 2250 roughly, right? You're actually up 200 points or roughly 10% on the year. And funds are actually in the last month going to chase things. They're going to try to, most of them are lagging the market. They're going to try to outperform the market. And really, that's what you want to do. Really, that's what they want to do. Or last year, I think the market didn't have a problem selling off after the Fed meeting badly because there really was no performance and no one was chasing everything. But I definitely think some of the high-flying stocks, they might hold up until the end of the year as people try to chase them. And also what happens is portfolio managers want those on their books. Like, for example, take a stock like Amazon, right? Even though it's off in the last few months, Amazon is up a great deal this year. So if you're a portfolio manager and you've missed out on Amazon this year, this stock began the year around 675. It's 768 right now. It's up 10%. You want to show that this stock is on your portfolio where, like, not just tax loss selling, but some of these losing type stocks. And I own a couple of these smaller, sort of beaten up stocks, and I know they might not move to the end of the year because the portfolio managers want to dump those, and because they don't want to, you got a stock that's down 50% year to date. They don't want to show that they own those. So I think that's something you have to take into account as well. But yeah, I would think that in January you're going to probably see some sort of sell-off, especially when people take profits from their winners of the year before. That often happens in the first week. But then I don't know if the correction will begin right away. I think it still might take a little while to unfold, but I definitely think that if you are someone who is worried that we are very frothy now, and look, I'm telling you, like, I know that I have actually been bearish for a little while now. But in terms of my long-term view, I turned a little less bearish shorter term after the election, and that's worked out because there has been this rally. But like now, I really think we're in this blow-off phase. I think we're like where silver was in 1979 or 1980, or silver did it again in 2011, or where the Nasdaq was in 99, 2000, and we are actually seeing another blow-off in the market. Now, not every blow-off has to be straight up parabolic like the Nasdaq, but these blow-offs can definitely last a few months. And what have we seen? We've seen the Dow rally 10% just since the election. That's only basically just over a month ago.
Right. And if you look at those blow-offs like silver you mentioned a couple years ago and the Nasdaq in 1999, when they happen, usually you do see pullbacks within them that last 1 to 3 days, and they can be a couple percent, and then things just keep going up. So that might be what's going on now. But I think you're right that in January, maybe right as the year starts, we could see the markets just fall for pretty sharply for a couple of days or even a week, as a lot of people who want to delay selling just sell then for tax reasons.
What you're going to see is this leadership shift that's gone on. Is you got a stock like, for example, Goldman Sachs is right at the top, right? If you get a sell-off and then a rally, probably a stock like that's going to continue to go higher, especially as these higher long-term rates kind of help the margins of these investment banks, right, shorter term. So that kind of stock. But if you go look at these FANG stocks, which have actually been lagging since the election, I think what would happen with them is they will actually act poorly on the sell-offs and lag on the rallies, and they'll begin to actually kind of roll over. So that's what you're going to see. You're going to see this rotation, and you're going to see the stocks that maybe have done well continue to do well, but you're going to see a thing where this happened in October 2007, as you know. You're going to see this unfolding where the market averages might be near highs for a few months, but a lot of stocks are going to start acting very poorly and kind of roll over. And look, and then also, too, is we've talked about these Trump trades, and I think some of these trades are, for a lack of a better term, bullshit. For example, I don't really believe the move in copper. That's because of some so-called infrastructure buildup, but the infrastructure actual numbers are very small compared to, say, what they spend in China. So that's number one part of it. And number two is, like Mitch McConnell and some of the people in the Senate don't want to do infrastructure, so it might not be as big, et cetera. So I think it's kind of like those kind of trades are maybe preparing for something that's not going to happen, and those kind of trades. And we've both seen that. Like, look what these shipping companies just did recently, right? These shipping companies went straight up and down in some crazy trades. Stocks like Dry S, right? So just don't think that the market is always correcting and anticipating these things. Actually, Dry S is not below the low of November, and it went from $3 to $100, and now it's back at $3. So I with some of these trades, I would be wary because I think the market is making a wrong bet on some of these trades. And where I kind of see the shift going forward, and I call it the end of hypernormalization, the end of kind of this dead zombie stock market and economy. And I think there's going to be a lot more volatility going forward. That's what I really see. I really see this just more volatility going forward, and there will be certain sectors that do well, but I don't think that some of these. I think that some of these bets are misplaced.
Well, what do you think next year the best bets to make are going to be?
Well, I think at some point towards the middle of the year, you're going to want to buy gold stocks again. Now, I'm not overly bullish on gold stocks right now. I've been in and out of gold bear funds, hedging my positions. I sold a lot of gold stocks in the summer. I sold more after the election. I bought a little bit here and there, maybe an individual stock I like for a reason. But I think that when they either gold maybe makes a move back towards its lows or back under 1100 or whatever it is, or goes bottoms in the low 1100s. I don't know, but if there's another leg lower here, it's obvious if you look at the gold stocks and where they are, they're still way above their lows of last January. They will probably hold their lows on such a pullback, and then you'll be able to buy some of them there. I have a couple individual companies. One is a healthcare company. The other is a tech company. And these are just individual trades. I'm buying them. These are turnaround plays. These are one company's down. Actually, they're both down like over 90% from their all-time highs. So I'm buying these as turnaround plays. And the nice thing about a turnaround play like that is, okay, on the one hand, they're not guaranteed to move higher when the market moves higher. But if the restructuring works at the companies, they can take off even in a correction in the stock market. So I'm just being very conservative and buying beaten up plays like that. And then if you look at some of the longer term trends, I bought Russia in December 2014. I sold a bunch into the rallies over the last couple of years. But you go look at the RSXJ, which is Russian small caps, or RSX, which are Russian stocks. They have been on a tear. And it looks to me like they probably did bottom back in 2014 and 15. So probably even if you get a bear market in U.S. stocks, those and be a good bet on such a pullback. Now I can't recommend those here. They're way overbought. They're way overextended. They need to pull back. So don't buy them here. But I think on a pullback you're going to get a good chance. And by the way, this has happened in the past. In 2000, 2001, Russian stocks bottomed in 2001, and a lot of emerging markets bottomed in 2001. Before the American markets bottomed in 2002, 2003. So this has happened in the past.
Right. Well, that'll be something we'll have to keep our eye on for this year. Definitely.
So, So actually, one thing I'm going to do, just Mike, just so you know, before the end of the year, kind of a preview next year, I am going to do an issue, and I've got a list, because I believe in this kind of maximum pessimism, reflexivity. It's kind of a Templeton and Soros beliefs in the markets. And I like finding these companies that are really beat up. Now, it's easier to find beat up companies if it's a whole market or whole sector. Like I just mentioned, Russia. A lot of these Russian stocks have gone up hundreds of percent because, the whole Russian market has done really well, right? So I rather buy, it's easier to buy that than when you're just trying to find these individual companies, because these individual companies are really, they're not going to have the kind of tailwind of their actual market, or country moving higher. So, but anyhow, what I'm saying is I've got about 10 or 12 stocks right now that are down, say 70, 80%. I'll give one away. One is actually the country of Turkey, which obviously has a lot of turmoil right now, a lot of political turmoil, a lot of economic turmoil. I think it's going to have problems in the raising rate environment. And I got a couple companies in Turkey I'm looking at that are already down a great deal, but I think they need this kind of one more leg lower. So I've got these dozen companies that are down, say, 70, 80%, that I think if we get a bear market in equities, can go 90, 95, even 99% down off their lows. And those are the kind of companies that in the ensuing rally can go up 2, 3, 500, or even 1,000 or 2,000%. So those are the kind of things I'm looking at too. But with that trade, you got to be patient. You just got to sit here and you got to wait. It doesn't sound sexy, but that's really what you got to do. You just got to sit around and be patient in some of those trades. And like we've talked about the casino stocks in the past, I tell people the only thing you had to do your whole life of investing was, I've been doing this for 20 years. And I didn't do it, by the way. But all you had to do is in 2009, you could have bought a basket of the casino stocks, and they all went up 10, 20, 50 to 1 from their lows. So really, in investing, we both trade and do these things, but all you really got to do is sit there, be very patient, wait for an opportunity to arise, then take advantage of that opportunity. And usually, by the way, the casinos were an extreme case. Greece in 2012, Greek stocks did very well for a year and a half after that. Russian stocks in December 2014. I just mentioned the casino stocks and obviously U.S. stocks as a whole in the spring of 2009. So usually every few years you'll find an opportunity like this too, but you just got to be patient and wait for it to unfold. Like for example, people will go nuts about some tech stock right now, but I mentioned Russian stocks. Just to kind of end off on that note, talking about this start of trade, the RXJ, which is the Russian small cap ETF. So we're not even talking about you had to own one stock. You could own this ETF. This thing from the beginning of 2016 has gone up like 150%. It's gone from roughly 16.
A lot of people are scared of Russia,
Oh, I know. Putin is hacking your emails and,
Yeah, the Washington Post did a story a couple weeks ago saying that Zero Hedge and 200 of the websites are under Putin's control, and a lot of people read that and believe it and are scared, and they may hear you talking about the possibility of buying a Russian ETF and wonder, are you a Russian agent for even suggesting such a thing?
My grandparents met in Russia after the war, so maybe. I know me and Mike laugh at these political things. So, but it just shows you, because I think what happens though is everyone gets obsessed with what's hot. Oh, right. They want to buy the Dow. You watch Charles Payne or Jim Cramer; they'll have the hot stock. Cramer's pumping this. It's one of my shorts. I just entered a position yesterday, so I don't want to mention the name, but it's a semiconductor company. It's gone straight up for about a year or two, and he's pumping this stock. But like I said, you could have bought, there's another Russian company, which I sold out of too early, actually, called Mekil Steel, trades under MTL.
Yeah.
And this stock from August, has gone from $1.50 to over $6. So you're not going to make 4 times your money on Amazon or Google. You got to find these kinds of companies. But, if you don't like Russia, if you think that Putin has ruined the election, if you think that these Russian hackers are going to, wipe out your computer, well, you could have bought something like CLF. This is an iron ore company in the United States that went from a few dollars to almost $10 on this rally as well. So that's really, in my opinion, how you make money. And one thing you got to do when you do those kind of trades, and this is why I mentioned I have these 2 individual companies, this is what makes it really difficult, Mike. It sounds easy. Oh, CLF used to be a $100 stock and it went to $1. Of course you buy it, right?
Right.
But what makes it difficult is twofold. Number one, there's usually a lot of rumors that these kind of companies might go under. And then number 2, which I find is difficult because the market itself is so overvalued, I myself start always getting I don't want to say too worried, but I get worried about the market falling a great deal and these companies having another leg lower. But I think what you really got to do is you're not going to get 100% of the things right 100% of the time. So you have some longs in these companies and you're hedged with shorts or bear ETFs, and if these companies get a little cheaper when the market goes down, so be it. You're not going to get everything 100% right. And if you're wrong, like I was wrong this year that the market would have this huge decline, well, you own companies like this and you make hundreds of percent. That's a good way to be wrong.
Right. That's true. Yeah. Well, I'll let you go, and next week Christmas, maybe or the next weekend. But maybe we'll do an interview then, or before New Year's, or sometime before the year's over. So. Yeah,
I think we both like the holidays because we can kind of the volumes quiet down. We can kind of look at things, and come up with our philosophies for the new year. I know me and you both like the new year for that reason.
Yeah, I mean, we got this Fed meeting today, and the volatility picks up during the Fed days, and you're seeing that in gold today. But typically the volatility does die out in just about everything, the last 2 weeks of the year. So that's kind of what I'd expect to see. Well, thanks.
Usually the week before Christmas and the week after Christmas / before New Year's, everything dies out.
Yeah. So, well, thanks for talking to me and everyone else. And again, till next time.
Yeah. Thanks for having me.